Warren Buffett's investing tip number 5: avoid debt. Understanding the risks of debt. High levels of debt increase a company's financial risk. During economic downturns or periods of low revenue, companies with significant debt obligations may struggle to meet their interest and principal payments, potentially leading to insolvency or bankruptcy. Interest payments. Debt requires regular interest payments, which can be a significant drain on a company's cash flow. These payments reduce the funds available for reinvestment in the business, research and development, or other growth opportunities. Reduced flexibility. Companies with high debt levels have less financial flexibility. They may find it difficult to raise additional funds when needed or to take advantage of new opportunities due to existing debt covenants and restrictions imposed by lenders. Assessing a company's debt. Debt-to-equity ratio. This ratio compares a company's total liabilities to its shareholder equity. A high debt-to-equity ratio indicates that a company is heavily financed by debt relative to equity, which can be a red flag for financial stability. Interest coverage ratio. This ratio measures a company's ability to pay interest on its debt from its earnings before interest and taxes. A low interest coverage ratio suggests that a company might struggle to meet its interest obligations. Debt maturity profile. Analyze the maturity dates of a company's debt. Companies with significant short-term debt may face liquidity risks if they are unable to refinance or repay these obligations when they come due. Strategic use of debt. Prudent borrowing. While Buffett generally advises caution with debt, it's important to recognize that not all debt is bad. Prudent borrowing can be beneficial if the funds are used for value-accretive investments that generate returns higher than the cost of debt. Investment in growth. Debt can be used strategically to finance growth initiatives, such as expanding operations, acquiring new businesses, or investing in research and development. The key is ensuring that these investments will generate sufficient returns to cover the cost of debt and create additional value. Economic conditions. The economic environment plays a significant role in debt management. In times of economic stability and low interest rates, taking on moderate debt for productive investments might be reasonable. However, in uncertain economic conditions, high debt levels can be particularly risky. Case studies and examples. Successful debt management. Look at companies that have successfully used debt to fuel growth. For instance, some technology companies have borrowed to fund aggressive expansion, resulting in significant returns that outweighed their debt costs. Debt crises. Study companies that have faced financial distress due to high debt levels. Examples include companies in cyclical industries, like energy or real estate, where revenue fluctuations combined with high debt levels led to financial trouble. Buffett's approach to debt. Minimal debt at Berkshire Hathaway. Buffett practices what he preaches. Berkshire Hathaway, his company, maintains minimal debt levels. This conservative approach has provided Berkshire with the financial flexibility to make opportunistic investments and acquisitions, especially during market downturns. Investment criteria. When evaluating potential investments, Buffett prioritizes companies with strong balance sheets and manageable debt levels. He looks for businesses that generate sufficient cash flow to cover their obligations and reinvest in growth. Practical application for investors. Personal investments. Apply Buffett's principle of avoiding debt to personal investments. Be cautious of using leverage to buy stocks, as this can amplify losses during market downturns. Focus on investing with your own capital and maintaining a diversified portfolio. Evaluating companies. When analyzing potential investments, prioritize companies with strong balance sheets, low debt-to-equity ratios, and high interest coverage ratios. Ensure that any debt they do have is being used prudently and strategically. Debt repayment plans. Consider the company's plan for managing and repaying debt. A well-defined plan indicates responsible management and reduces the risk associated with high debt levels. Long-term financial health. Stability and resilience. Companies with low debt levels are generally more stable and resilient, particularly in economic downturns. They are better positioned to weather financial challenges and capitalize on opportunities when they arise. Sustainable growth. Sustainable growth is more achievable for companies that manage their debt wisely. They can reinvest profits into their business rather than servicing high debt levels, leading to compounding growth over time. Behavioral aspects. Risk aversion. Adopting a risk-averse mindset towards debt aligns with Buffett's conservative investment approach. Avoiding excessive debt reduces the risk of financial distress and promotes long-term stability. Patience and discipline. Maintaining low debt levels requires patience and discipline. It may mean slower growth in the short term, but it builds a stronger foundation for enduring success. By focusing on avoiding excessive debt, investors can enhance their financial stability and resilience, both personally and within their investment portfolios. This principle is fundamental to Warren Buffett's investment philosophy and contributes to his long-term success. Click the link below for more investing tips.